coming in hot here today, my friends. Above
Yeah.
expectations. What do you make of this report?
Well, it's interesting that you describe it that way because I think, once again, we sort of have to look at the parallel dimensions when we're talking about these inflation numbers. Because certainly on the bright side, for the most of us who are walking around in the world, when we see consumption rising, when we see incomes rising, when we see spending rising, that all should suggest a healthy economy. A healthy economy is what we are all striving for. So to some degree, the numbers were happy because they reflect the fact that the US economy is ticking along at a very healthy pace. Atlanta Fed's GDP now says that's about 2.5%. It ended the year with a 2.7% pace. So that's nice momentum coming into 2023. There's more bets that we might be able to avoid recession along the way. And of course, we had that blowout January jobs number and the slowest number of weekly jobless benefit claims in about 2 months. So all of that together, JD, should be very positive. The one caveat against it, of course, is that with that growth comes faster inflation. And that is really the pivot point for the markets today. The core reading of that PCE price index, which is what the Fed pays the most attention to, sped at the fastest month-on-month pace since June. It doesn't seem like much, it's only 0.6%, but nonetheless, it was well above the street forecast and actually accelerated from the month of December. So the Fed is worried that the sticky inflation that they've been warning us about is not only staying put, but slowly rising, and that's the last thing they want to see. So as a result, people are betting that the Fed might have to go faster and harder on rate hikes to tame that inflation and may have to hold those rates in place for a longer period of time. And collectively, that's what's putting pressure on the stocks today.